Hi and welcome to my channel. My name is Dave, I work in financial services and these videos are a mixture about my journey and development towards financial freedom. They will cover financial products and they will also cover financial well-being so you, like me, can reach your financial aims and objectives sometime in the future. Now let's get into the latest video. Now at the moment we are living in unprecedented times for a lot of relatively new investors. Firstly, the markets hate uncertainty, which spooks buyers who then turn into sellers, and when there are more sellers than buyers, stock market prices, shares, funds will drop. We've had the COVID issue, we've now got supply issues. We've also got rising inflation at 40-year high in both the UK and the USA. And if you switch on the news, certain channels, we talk about bad news every day. Unfortunately, bad news sells, and we talk about the oncoming recession. The markets will have good days, they will have bad days. It's been proved over the past 100 years. It just depends in a way. How do you react as an investor to current market events? One of the first things you need to do about finance and investing is change your mindset, so create a positive mindset. The market will always go up and down. It is a regular occurrence. Avoid short-term noise. In the past 100 years, shall we say, there have been 15 so-called recessions. We have always recovered. The market will fall 20%. It's what we consider a bear market. They normally last shorter than bull markets, where obviously prices will rise. But have we reached the bottom? It may well be you do stay calm, but don't look at your shares every hour, every day. You will just see a wall of red. And during these times, markets can appear to be very volatile and erratic, and it may well be have large daily swings. So some days it may go down 2%, it may go up 2%, it may go down 1%, it may go up 1%. No 2 days are the same, but this is what we're seeing now as more and more as a common event. It is happening on a much more regular basis, mainly due to the times we live in, and mainly due to economic, shall we say, or we live in a much faster paced investment environment. So the markets will react quicker to good news and bad news. If you are investing like me, find your reason why. What are you investing for? What are your financial goals in the short, medium and the long term? What are your investing objectives? Maybe the next 12 months, the 3, 5, 10 years. What are you investing? Why are you investing? Are you investing for a numerous certain conditions? Is it to beat inflation? Is it to get better investment returns from a bank or building society? I invest because one, I enjoy it, and two, it's given me the opportunity to build wealth. During these times, see it as a buying opportunity to buy great companies at discounted prices, which will recover and will pay off handsomely in future. Okay, it may well be you buy more shares at a cheaper price. Okay, but one thing you may consider during these times of uncertainty is what is your investment attitude to risk? Do you think long term? Do you think short term? Are you spooked by investments every day? It may well be as part of the process in the next few weeks or months. It may well be you review your attitude to risk. But remember, why are you investing in the first place? Is it something specific for you, your family, or to create some kind of generational wealth for your family moving forwards? Now, during these turbulent times, shall we say, one thing you should do is you should keep investing, keep into the habit of investing. Pay yourself first and do what we call dollar cost averaging or pound cost averaging. Keep investing in the market on a regular basis. If prices drop, you're going to buy more shares or assets or funds for a price for the same investment amount, but you're going to get more allocated shares or units. Prices will always recover, so see it as a great buying opportunity to buy great companies or funds at a reduced or sale price compared to its true market or intrinsic value. So on each payday or the first of the month, set aside an amount you can afford and you can invest. And it may well be a percentage amount. It may well be a fixed amount, but keep into the habit of investing. Or it may well be you can afford to invest more during these times to take advantage, but think long term. I've recently been buying shares in UK insurance companies. They've been around for years, very safe, boring, cash rich. Everybody needs insurance, whether it's life, home, car, or it may well be workplace pensions. But the shares I'm buying themselves at the moment, I'm not going to name them, but they're giving me good yields of between 6 and 8%. And I'm buying them for lower prices now than what I bought 2-3 years ago, but it will give me greater dividends, a greater compound. If you're unsure about what shares to buy yourself, it may well be you stick to a low-cost tracker fund. Very low funds across numerous sectors, and it will cover all bases across diversification. And remember, it is only a loss on paper. Time in the market is better than time in the markets. A simple example. My self-invested personal pension for the past 6 years when I've been recording it is giving an annual return of 12.33%. Now this year it's down nearly 3% year to date, but I'm still making contributions on the first of the month of £200 and I'm getting tax relief. Okay, my self-invested stocks and shares ISA for the last 3 years made an annual return of 21%. This year to date, it is down nearly 9%. I've made contributions of £10,000 for this tax year from April. Moving forwards, I'll be making monthly contributions of between £500 and £1,000. So hopefully I will use my whole £20,000 tax-free allowance, but I am buying increased holdings at a cheaper price than what I bought them originally. And with regard to those current shares or funds I'm buying, I have no plans to sell. They're what I'm going to hold them for the next 3 to 5 years, unless something seriously happens or is fundamentally wrong with that company or that respective fund. So see it as a buying opportunity to increase existing holdings or new holdings, which will pay off handsomely in future years. Now, I consider myself to be what we call a long-term investor. I can't remember the last time I sold a share. Okay, maybe it'll be several years ago. I think it was JD, way back in 2020. They had a good run, they doubled in value, and I'd sold half my shares at a profit to diversify. Okay, so think long-term. The markets will recover. It may take 12 months. It may take 2 years. Look at the recent events of COVID in 2020. The markets tumbled in 2020. They recovered over 30% in 2021. And if we think of the average stock market return in the US and the UK, over the past 100 years, the S&P 500, as a simple example, is giving an annual return on average of 8%. So think long term, okay? Don't buy shares on a whim. You're going to sell a few days later. It just does not make sense. On that basis, do not sell your shares at a loss. Although you may look at your portfolio, do not sell. Think to yourself, why did you buy that share or fund in the past? Has the fundamentals changed from that company or fund? A loss is only a loss when you sell and you crystallise that loss. Unfortunately, most investors will be spooked by recent events. They may well be they buy high and they sell low, but it defeats the object of investing. You should do the opposite. You should buy low, and if you're going to sell high at a much better price. Unfortunately, that's what separates around about 90% of investors versus what we call successful investors. Okay, it will serve as a double whammy. It will cost you fees to sell that money. You're going to sell at a loss, and it may well be you then buy them shares back at a later date, so you're going to incur more fees. It just does not make sense. In my stocks and shares ISA and my pension, I have between 15 and 25 shares. That is my own attitude to risk. predominantly based in the UK, or one portfolio, and the second portfolio is a mixture of UK and Americas. But that is my attitude to risk. But all my funds I hold are invested to buy newer shares at discounted prices. So whether that's I receive dividends, it's all reinvested. And whether I make contributions, it's all to increase existing funds or shareholdings to buy at a present price. And one thing it will do, it will increase my level of compounding. So as those assets will grow. So next year they will give me more dividends and more dividends and more dividends over the years to come. But it's done for a specific reason. So although probably half my shares are showing at a loss and half at a profit, I don't need the money. I have no intention to sell. It's a long-term plan so I can retire early and then hopefully place generational wealth for me and my family moving forwards. But that is my reason why. So remember, why you're investing, think long term, don't panic. The market will always recover, but how do you react to current events and what are your future plans through moving forwards? Remember, if you like the videos, smash the like button, subscribe to this channel, and we'll see you again soon.